All right, guys. Today we'll be talking about places to place your stop loss and your take profit whenever you're trading with the moving average, especially when you enter your trade based on the moving average setup. I have noticed that many people ask these questions a lot, and that is what we'll be talking on today. That's what we'll be talking on today. Now, if you have not watched the videos on moving average, then you have to go back to watch the videos on moving average because you have to go back and watch the videos on moving averages. The videos on moving averages, I recorded them the last time, and please do it to watch them in order for you to be able to understand this current videos. Now, already we talked about the moving average in a situation whereby we have the moving average this way and price in the bearish market comes to this point of moving averages. There's a particular reason why price is going to not just reverse on the moving average, but instead price is going to drop. And that is one key things we want to be talking about today. And the next thing we want to talk about is where will the stop loss or the take profits be? So guys, let's get started. All right, now, one thing I want us to understand is this, the market structure. The market structure has a lot to play with this particular moving average setup together with the time frame sequence, together with the time frame sequence. Now, the time frame sequence and the market structure has a lot to play. And what we want to look at in the time frame sequence is the main time frame and the primary time frame. Now, we all know the main time frame here is the time frame that has the moving average touch, the highest time frame that has the moving average touch. In the sense, price is the monthly moving average, price is the weekly moving average, and the daily moving average. That particular time frame where the moving average is being respected, in the sense that price has touched the moving average, that is going to be our main time frame, our main moving average time frame. Please take note of that. The time frame where price touch the moving average as our key moving average main time frame. Now, when it touches 2, 3, or 4 moving average at this time frame at the same time, that means it touches the 1 hour, 4 hours weekly, and the monthly, then the highest time frame should be the main time frame. Now, having said that, the second thing is this. When we have the touch, you want to flip over to the primary time frame of the main time frame. And when you flip over, what do you want to look for? You want to check out for this, the market structure. You want to check out for the market structure. You want to check out for the market structure. Why the market structure? The market structure in the sense that the market will not be able to break the market structure level. Now, let me just show an example. When price does this is assuming this is the daily time frame, and we have the moving average here. This is the touch. Your duty is to come down to the main time, the primary time frame, which is 1 hour. 1 hour will be this, something like this. And then now this particular level, I would like to put a line here. Now, when price touches this particular moving average, this is the daily moving average. And in this particular 1 hour time frame, this is our market structure level. Yeah. Now, what the market will do is this. The market is going to go back up to this point and drop. Or the market is going to do this. Market is going to do this. Either they take price back up around this point and they drop. What are they trying to insinuate here? Very, very simple. They're trying to tell us that as long as the market structure still stands in the primary time frame, price will continue to trend. Yes, with the moving averages. As long as the prime market structure still stands in the primary time frame, price will continue to trend regardless of the market structure, the key level areas it touches. Regardless on the key level area here is the moving average. So regardless of the moving average, the market is going to do what? Drop. Now, where do I put my stop loss? My stop loss is always around here, above the market structure. And I actually make use of the time. What is the time frame? And normally I love to see it close and around there. I want to see a particular close above this market structure at the end of the day before I can assume that it's a failed trade. So that is why I put my stop loss above the market structure. My stop loss wants to be in the market structure level above them. And my take profit, of course, is going to be open until I have another formation that signals the what, a breakout. I will have a what that's going back up. So this is actually what you want to see with the moving average. So we'll go over to our chart and get some graphical and real life examples, then we continue. We end the lectures rather. All right, now we'll be taking examples, and this is one. Let's use this. Make use of this particular zone where we have the daily moving average. We have here around this time, around this point, this level, around this level. So we just pick these levels, make our examples with them. Then we do what? We run up. Now the first particular one level here, remember this is the daily time frame, and I said the time frame whereby price is touching the market structure becomes our main time frame. Now the price is reacting to the moving average level rather of the daily time frame Euro USD. We have to do what? Switch over to the 1 hour. We switch over to the 1 hour. And what do we want to see? We want to see a break in the market structure. If you notice, this is the market structure here. Now, price did not break the market structure here. It did not break the market structure here. It did not break it here. It did not break it here. What happened? This is the area of the moving average in the daily time frame. And since it did not break it, price went back up. To tell you that the trend still continues what? Bullish. Now let's check another one, the second one. And this is the second. This is the second one, this particular one here. This is the second one. Let's see. All right, this is the second one. If you can notice, this is for a sell. If you notice, price from our market structure, it did not break market structure. It came down, came down, came down, came down, came down, boom, until we have a break here. Until we have a break here. Until we have a break here. Remember the last time I drew the structure. The last time I drew the structure, I drew this. I said the market is going to drop, obey market structure, obey market structure, obey market structure, obey market structure, then form the UTEP, our ultimate entry pattern, then continue the rise. Remember I did this. Now, if you notice something, what is that? This areas here, my stop loss will be above here. All these areas, my stop loss will always be above the market structure. Market structure, because market structure determines the end reversal of the trend. So these points are my stop loss region above the market structure. Above the market structure. And like I said, I input them with time, the time frame sequence. So this is another example. Now let's continue. Now let's use another example. We'll go back to the daily. Go back to the daily, the next, okay. This is for a bullish run. This is it. Now, if you notice around this point also, we did not have a what? A break in the market structure. This is it. There was no break. And now, okay, yeah, at this point we have a break, but what happened? It was not confirmed. It was not confirmed. Let's go to the daily. You will notice that these are weeks. Weeks where they printed the low of the day. Can you see? They are all weeks. And so price advanced back up. See, it's a week. And so price advanced back up. Price advanced back up. Now this area is going to be our area of stop loss, market structure level, then take profits, we go above until I see another one, put formation forms to scatter the previous one. Now let's go down to the last one. We'll call this the end of today's video. And this also, this is the daily time frame. What you notice is there is no break in the daily time frame, the 1 hour time frame market structure. Can you see that? This is where the market structure break. First, for continue to sell. We have a structure here, it did not break. We have a structure here, it did not break. Now, this is the key structure, but what happened? These are levels where we have a breakout in the structure. But if you go back to your daily, you'll notice there are wicks. Can you see there are wick candle shadows in the daily time frame? So that's why I said my stop loss is always above. My stop loss is always above. My stop loss will always be above the levels, the market structure levels, above it. And I normally associate it with time, then I let the trade to run. So that is it on the moving average. Stop losses and how to scale into the trade. Now, I want to talk about very quickly about imbalances. Now, imbalances happen within 3 candles. This is the first one, the second one, 2, then the third one, 3. Now, what is... All right, so thank you for today's video. Don't forget, watch the previous videos on moving averages to get more tips on how to trade using the moving averages. Thank you and God bless you.